Lesson: Dynamic Risk Modeling in Blockchain Systems. Dynamic risk modeling in blockchain systems represents a critical advancement in the field of blockchain and AI risk management. This approach allows professionals to effectively anticipate, assess, and mitigate risks associated with blockchain technologies. Unlike static risk models, dynamic risk modeling adapts to the changing landscape of blockchain systems, offering a more robust and responsive framework. The adoption of dynamic risk models can significantly enhance the efficiency and security of blockchain systems, ensuring that they remain resilient in the face of evolving threats. At the heart of dynamic risk modeling is the ability to incorporate real-time data and analytics into risk assessment processes. Traditional risk models often rely on historical data, which may not adequately capture the current risk environment. In contrast, dynamic models leverage real-time data inputs, allowing for the continuous updating of risk assessments. This capability is particularly relevant in the context of blockchain systems, where the rapid pace of technological innovation and the decentralized nature of networks can lead to emergent and unpredictable risks. A practical tool that exemplifies the dynamic approach to risk modeling in blockchain systems is the Bayesian network. Bayesian networks are probabilistic graphical models that represent a set of variables and their conditional dependencies through a directed acyclic graph. These networks are particularly useful for modeling the uncertainty and complexity inherent in blockchain systems. By updating probabilities as new data becomes available, Bayesian networks can provide real-time insights into the risk profile of a blockchain system. For instance, if a new vulnerability is discovered in a blockchain protocol, a Bayesian network can quickly adjust the risk assessment to account for this new information, enabling more timely and effective risk management decisions. Another essential framework in dynamic risk modeling is Monte Carlo simulation. This technique uses random sampling and statistical modeling to estimate the probability of different outcomes in a process that cannot easily be predicted due to the intervention of random variables. In the context of blockchain, Monte Carlo simulations can be used to model the potential impact of various risk scenarios, such as a 51% attack or a sudden drop in network hash rate. By simulating thousands of possible scenarios, professionals can gain a comprehensive understanding of the potential risks facing a blockchain system and develop strategies to mitigate them effectively. In practice, implementing dynamic risk modeling involves several critical steps. First, professionals must identify the key risk factors relevant to their specific blockchain application. These may include technical risks such as vulnerabilities in the code, operational risks like network congestion, and external risks such as regulatory changes. Once these risk factors are identified, the next step is to develop a risk model that accurately represents the relationships between these factors. This often involves the use of statistical and machine learning techniques to analyze historical data and identify patterns that can inform the risk model. Once the risk model is in place, it is essential to continuously update it with real-time data. This can be achieved through the integration of data feeds from various sources, such as blockchain transaction logs, network monitoring tools, and external data providers. Advanced analytics platforms can automate much of this process, providing real-time risk assessments and alerts to help professionals quickly identify and respond to emerging threats. A case study highlighting the effectiveness of dynamic risk modeling in blockchain systems is the implementation of such models by financial institutions involved in cryptocurrency trading. These institutions face a unique set of risks, including market volatility and cyber threats. By adopting dynamic risk models, these institutions have been able to better manage their exposure to these risks, resulting in improved financial performance and reduced losses from security breaches. For example, a leading cryptocurrency exchange implemented a dynamic risk model that continuously monitored transaction patterns and network activity for signs of fraudulent behavior. This model was able to detect a sophisticated phishing attack in real time, allowing the exchange to prevent significant financial losses and protect its customers. The adoption of dynamic risk modeling in blockchain systems also has important implications for regulatory compliance. Regulators are increasingly focused on ensuring that blockchain systems are secure and resilient, and dynamic risk models can play a critical role in meeting these requirements. By providing real-time insights into the risk profile of a blockchain system, these models can help organizations demonstrate their compliance with regulatory standards and respond more effectively to regulatory inquiries. Despite the clear benefits of dynamic risk modeling, there are also challenges that professionals must consider. One of the main challenges is the complexity of developing and maintaining dynamic risk models. This requires a high level of expertise in areas such as data science, machine learning, and blockchain technology. Additionally, dynamic risk models can be resource-intensive, requiring significant computational power and data storage capabilities. Organizations must carefully weigh these considerations when deciding whether to adopt dynamic risk modeling. Moreover, the effectiveness of dynamic risk models largely depends on the quality and accuracy of the data used. Incomplete or inaccurate data can lead to erroneous risk assessments, potentially resulting in costly mistakes. Therefore, it is crucial for organizations to implement robust data governance practices to ensure the integrity of their data inputs. In conclusion, dynamic risk modeling represents a powerful tool for managing the complex and evolving risks associated with blockchain systems. By leveraging real-time data and advanced analytics, professionals can gain a more accurate and timely understanding of the risk landscape, enabling them to make more informed decisions and protect their organizations from potential threats. The integration of frameworks such as Bayesian networks and Monte Carlo simulation can further enhance the effectiveness of these models, providing actionable insights that can be directly applied to real-world challenges. As the blockchain industry continues to grow and mature, the adoption of dynamic risk modeling will be essential for ensuring the security and resilience of blockchain systems, ultimately contributing to the broader goal of fostering trust and confidence in this transformative technology.